Hi everyone. Sorry for the delay. Nice to meet you everyone. My name is Alexis, and today I'm gonna present you JellyFi, which is the new capital efficient lending protocol. So I'm gonna talk first about what we are building at JellyFi and why we are building it. So first of all, I'm gonna talk briefly about the DeFi lending state, and just to know who did already land on Aave or Compound already? Okay, so everyone basically. Cool, so for the people on internet then, briefly to understand, lending on like 99% of lending on Ethereum as of today is peer-to-peer, and every loan requires yourself to actually deposit first some assets in order to be used as collateral, and this collateral is here to reduce the risk of counterparty, because peer-to-peer are in a sense risky. And usually the collateral ratio is about 150%, so which means that in order to borrow $1, you need to first deposit $1.5 worth of assets on the lending protocol. And that brings us to the pain point and why we are building this. The pain point is over-collateralization. So like I said, most protocols require yourself to over-collateralize your loans. And so that's a blocker for majority of use cases, because in terms of capital efficiency, it's really bad, and that's cool for the peers, but for the corporate market, it prevents corporates to have access to ways to finance their development or add liquidity to their protocol through borrowing. And that's why we decided to create JellyFi, which is tackling the corporate credit market. And basically, it's a lending platform aggregator that enables audited dApps and protocols to access zero-collateralized loans. So there is two sides to it. There is the lending side and the borrowing side. On the lending side, you will have lenders, which basically will be depositing assets directly to the borrowing pool, or delegating their credit lines through credit delegations. So for instance, you will have people that have deposited assets on Aave or Compound, for instance, DAI. And so what you will be able to do is use your A DAI or C DAI and deposit them on our protocol, and you will earn an extra yield on top of that. On the other side, you will have the borrowers, and those borrowers will be coming, and once they have been whitelisted and selected, they will be able to access a new source of liquidity and funding through our protocol and for various use cases. And so those use cases, there are multiple ones. First, we are looking at corporate credit. So that's basically funding through debt. As of today, protocols and dApps only fund through seed, series A series, B series, and stuff like this. And so there is a number of cases where protocols and dApps would rather want to actually trigger a credit line, instead of having to go through another round and sell more tokens and stuff like this. We are looking as well on being the de facto liquidity provider for fast withdrawals. I don't know if you're aware of what fast withdrawal is, but fast withdrawals, in a sense, is a type of withdrawal that allows its users to withdraw from the layer 2 without having to wait for the L2 blocks to be mined. And under the hood, what it uses is a withdrawal liquidity provider. And so we aim at becoming this de facto liquidity provider for the whole DeFi ecosystem. There is also another hot topic lately, which has been the DAO treasury. And so we've been seeing more and more advocation and use cases regarding usage of credit lines for smaller and bigger DAOs using their native tokens as a collateral or other means. And regarding the smart contract architecture next, So I know it kind of looks like next SpaceX planetary travel roadmap, but bear with me as I explain it. What you have on the left side is the governance module and placeholder, and basically what it does is orchestrate the whole protocol. What it can do is, once a protocol has been whitelisted, it can create borrower pool through all factories, and it can also adjust parameters of the borrowing pool, such as, for instance, the interest rate. Each borrower pool is associated with two smart contract proxies, which is the borrower manager and the position token. The borrower manager manages the data and the credit history of each borrower pool, and the position token represents your position in the borrower pool as a lender. Going back to the governance, there is also obviously the depositor, which are a trigger interacting with the borrower pool, depositing or delegating their funds, and the borrower, which are actually borrowing and repaying their funds, and they can interact only with their own liquidity pool. Regarding the governance module, there is what you can do as well is trigger the JellyFi safety module. So in case of default mitigation, so for instance, when a borrower is not repaying, the governance module trigger the module, and it repays the losses of every people that have been damaged in the pool. On the other hand, when a borrower will repay part of its loan, there is a fee which is taken from the interest rate in order to replenish the reserve. So that's the first big piece that we built, and that we are continuing on improving. And the second big piece that we are building is what we call the risk assessment framework. So it's how we are mitigating the risk and assessing the risk of each protocol that are coming to our platform and our protocol. So as of today, what we are looking at is what we call reputation risk. So basically, what's your reputation in the DeFi ecosystem? We're looking at a diversified portfolio. So for instance, if there is 3 protocols that are borrowing from a protocol, for instance, ABC Corp 1, 2, and 3. And as a lender, when I'm lending on JellyFi, I can choose specifically who has access to my credit lines. And so if, for instance, I only allow ABC Corp 1 and 2 to access my credit lines, and ABC Corp 3 is going default, I won't be impacted at all by the loss of this protocol. And lately, we have the JellyFi safety module that I talked about previously, and we are looking at limited maturity use cases because that enables us to build faster credit history. In a later stage, we are looking at on-chain insurance. There is a number of initiatives in the ecosystems that are building such products that we could partner with and offer a way to insurance yourself against smart contract failure on exploits. We are looking at building a credit default swap marketplace that could have like institutional on the selling side that could work as well as an insurance stuff. And we are looking at implementing legally binding smart contracts with the borrower and the lender. So I guess you all know OpenLaw, and so you could picture some cases where you could see you could create a smart contract that applies with the borrower and the lender, and in case of mitigating and default, you could bring into a clearance court, for instance, to settle the agreements. And we are looking as well on trustless way to lock future earnings in case of default, and so we'll be earning the earnings that they will be locking in the smart contracts, for instance. And now it's time for a demo. Okay. Is it running? Yeah, cool. Okay. So what you see is the app, JellyFi app. So we are connecting with two accounts. There is one lender account and one borrower account. You see there is $12 as TVL, so we're really high in the ranking. There is nothing in our dashboard because we have no transaction yet, and we didn't do anything. So first, what we're going to do is lend some a DAI. So we previously lend some DAI on Aave. We have some a DAI in our wallet, and so we are lending 3,000 a DAI to ABC Corp. So we trigger a deposit. So we first sign the message. Once the signing has been done, we are triggering a transaction. And once the transaction has been mined, you will see that the dashboard update accordingly. And basically, what you will have is a pool with 3,000 DAI that has been updated. So yeah, here you have the total asset that you have been that you lent, the total gains that we've been starting to earn. There is the protocol APY, which is basically the APY that you are earning on other protocols. So that's the APY of Aave as of today. And you have the JellyFi extra APY, which is of 0 as of today because nobody borrowed on the borrowing side. So the total APY is of 264, and you have like the transaction that you've been putting in the protocol. So once that is done, we are going now on the borrowing side. So we will act as a borrower. So we'll switch accounts, and you see that first you can't have access to the borrower panel because you have not been whitelisted first by the protocol. Now you have access to the borrower panel, and so what it will want to do is now borrow some DAI. So it's going to borrow 2,000 DAI and trigger a transaction. You see that as of today, there is 100 DAI in his wallet. So it's triggering a borrow. So we perform a borrow transaction on smart contract. So the transaction has been mined. We have now a loan of 1 day as a maturity. And now you see that we have 2,100 DAI. So the transaction now appears in the loan dashboard. You have like the balance and data and interest rate and the maturity that you can see. And so now we will go back to the other part. So going back to the lending part, you will see that the data has been updated accordingly. And so going back to the lender, so now you see that there is one current loan, that there is $2,000 that have been borrowed, worth of asset that have been borrowed on the protocol. And so you've seen that now there is a JellyFi extra APY that has been being generated. And so now lending stablecoin, you basically doubled your APYs going on our platform. And so you see that there is on your position of 3,000 DAI, there is 2,000 that have been borrowed. So there is the transaction which is here, and you have information on the borrower, his sales ratio, stuff like this, further down the page. So going back now to the borrower, he will now want to repay its loan because the maturity has been done. He did what he wanted with that. And so it's going to trigger repay. It can repay partially or full. So it's going to trigger a full repay. It's going to sign the transaction. Sign the transaction. The transaction is going to be mine. It's going to be repaid. So what you will see now is that in his wallet, he won't have 100 DAI anymore because he will have paid interest. And so what you see in his assets now is it has 99 DAI and 99.999. So you basically repaid the principal plus interest. So going back to the lending side, now everything, there is no APY anymore because there is nothing borrowed. And so you have the total earnings and there is no current loan anymore. So what the lender would want to do is withdraw his earnings. So it will trigger a withdrawal from the borrowing pool. And basically, what you will see as of that is that you will now earn 3,000 plus interest from the borrower. So yeah, that's about it. Okay, and for the last part, so what you saw is the alpha, and we are releasing it on Coven. We are later going to release it on Mumbai, which is the testnet of Polygon. And we are later this year going to enable the credit delegation feature, which we didn't impact in the app as of today because it has been quite a challenge in terms of gas optimization. And we are going to looking at launching on the Polygon mainnet with one partner, one selected partner. And we are looking at having all audits on Q1 2022 and start scaling the protocol from there. We are looking at other L2 solution to deploy later next year. And we are going to create the DAO and release the token. So we have some announcement as well. So like I said, the alpha is live. We are hiring in all departments, so if you are looking to join a motivated of builders and hop in the DeFi ecosystem, please reach us. We have like black t-shirts and white t-shirts with JellyFi written on it. So, and we secured a grant from the Aave Grants DAO. And also we are closing a round of $4 million in order to accelerate our developments. So yeah, thanks a lot, everyone. And if you have any question, please.
One quick question on the rate when there was the extra APY. How is that rate calculated, and do you take into account the risk?
Yeah. So it's algorithmically calculated. So as of today, we are still working on this. We are building models that take into account the risk of each borrower, and it's also dependent on the utilization, what we call the liquidity ratio of the pool. Obviously, if there is low liquidity in the pool, the rate will go higher in investment. Like if there is a lot of liquidity, it will, and not a lot of utilization on the borrowing side, you will have a low ratio.
So hi, I was wondering, you said that for the whitelisting you need to have kind of a reputation already in the system. How will it work for startups who are joining this the industry, and how do you measure it?
Yeah, that's kind of egg and the chicken story. So you want to build with really high value partner that have a big reputation, but at the same time, the people that is the most fundings are the early stage startups, and so obviously they don't have a big reputation. So that's why reputation is one key element. But we are working on a lot of other mechanisms that could enforce this and lower the risk as much as we can for those protocols. So we've talked about insurance mechanisms, we've talked about CDS, we've talked about limited material loans, credit history, stuff like this. So all of those options we should make us able to lessen the risk of each protocol, and at the end of the day, if you are willing to participate and loan for riskier option, you will have a higher APY, but obviously you will have higher risk. In what we are doing here, doesn't it's still a risky. There is still a risk involved, so you still need to be sure of what you are doing. You are taking the decision at the end of the day. Okay, cool. Thanks a lot, everyone.